Today we're going to talk about long-term interest rates. I'm talking 10-year, 20-year, 30-year treasury, and 30-year mortgages, and why I think those rates may not come down in any meaningful way for the next 10 or even 20 years. These rates may stay where they are and possibly trend higher over the next decade plus. I'm going to give you my reasons for why I think this is possible. And those reasons are the amount of debt that we have in society and the interest expense on that debt, our outlook for inflation. I think it could become higher than people realize over time. The deficits that the government is going to run for the next 10 years, they're insane. And the long-term impacts of quantitative tightening and quantitative easing. Let's get into it. Here's the showstopper, folks. We are now at $100 trillion of total debt in our society. When you add up the sum total of government debt, state debt, corporate debt, mortgage debt, credit cards, student loans, et cetera, when you add it all up, we are now at $100 trillion. And so for every 100 basis points, every 1% move in interest rates, that corresponds to about $1 trillion of additional interest that we're paying in our society. I think we're at a tipping point with this amount of debt, and it's going to make growth much more of a challenge in the years ahead. Government debt as a percentage of the economy, GDP, has literally exploded since 2008. We are now at 120% debt to GDP. Now, I hear people say, well, we've been worried about debt and deficits going all the way back to the 1980s. But I'd like to point out that in 1980, we were at 30% debt to GDP, a much more manageable situation. Even in the early 2000s, look where we were. Under 60% debt to GDP. It's the last decade, and really since COVID, that we have just gone wild with spending money that we don't have, printing money, borrowing money, and spending, which is all inflationary. Here's a look at one of the primary drivers of the recent inflation. We are looking at the Congressional Budget Office budget for 2024. The CBO is a nonpartisan institute. And here's what they show for 2024. We have revenues, this is taxes, coming in of $4.8 trillion, but outlays, spending of $6.8, almost $2 trillion of a deficit. But it gets worse from there. If we look at 2025 to 2030, what do you see? Nearly $2 trillion in deficits every single year and growing. And as we go out, this is their 10-year budget forecast. It's available on their website. June of 2024 is the most recent budget. That's what we're looking at. As we go out to 2031 to 34, we're over $2 trillion every single year in a deficit. What does this do? This keeps adding to the debt pile that we have and making the debt to GDP situation worse, and also creating a situation where we need to spend more and more money on interest. Here's a look at the net interest expense that we had for the government debt in 2014 versus projected 2025, and I've compared that to defense spending. In 2014, we spent $594 billion on defense, $231 billion on net interest cost. But in 2025, it looks like we're going to spend projected $895 billion on defense, but over $1 trillion on net interest. The growth rate for defense spending is 151%, but the growth rate on net interest is off the charts. It's 440%. So this becomes inflationary. What's happening is we're crowding out other things that we need to spend money on because the net interest is going to start to consume us in the years ahead. How can you pay for everything? And I'm talking about Social Security, Medicare, defense, etc., when you have to pay for net interest cost. As we move forward with larger and larger deficits, that means that the government is going to borrow more and more money and print more and more money. and the net interest expense is going to rise higher and higher. So what does that all mean? It means that we're going to be inflating. They're going to inflate and inflate and inflate. And you should expect inflation in the years ahead as the government continues to run monster deficits. Now look, there are only 4 ways really to deleverage. The ways that the government can deleverage are to raise taxes significantly, and that never works historically. It will cause an immediate recession or depression. They can't raise taxes enough to solve this problem. You could also cut spending, and governments historically have experimented with this, but you can't cut spending enough to solve the problem. And also think about it. One person's spending, the government's spending, is another person's income. There are lots of companies and contractors who receive contracts from the government, so the government spending is supporting a lot of jobs and it's helping the economy. So we can rule out raising taxes and we can rule out cutting spending. That leaves us with confiscation of wealth, and that never goes over well. So you can rule that option out, although some governments have tried it. So what's your last option? Inflation. It's the only palatable option for politicians, and it's what we're going to do. They're going to keep spending money and causing inflation, and therefore you can expect that long-term interest rates are probably more likely than not to at least stay where they are and probably trend higher. Here's a look at core inflation back to 1970, charted against the 30-year mortgage. 30-year mortgage is the blue line. Core inflation is the orange line. What jumps out is that core inflation usually is going to be less than the 30-year mortgage. There's always going to be a spread, right? And the reason for that is that if you're an investor in mortgages, if you're lending money to somebody, your money's locked up for 30 years, you want to get a return above inflation. So mortgage rates typically should be higher than inflation. Whatever happened right here, just totally insane. I don't know who in their right mind would invest in a 30-year mortgage at 2.5% or 3%. That's just madness. And we'll probably never see it again in our lifetime. But I also want to point out that if we do enter an inflationary decade ahead, or even 2 decades, if inflation starts ebbing and flowing like it did in the 70s, then you can anticipate that mortgages are going higher. They're not going to do what Lawrence Yun incorrectly predicted back in late 2022, early 2023. Here's Lawrence Yun, the chief economist for the National Association of Realtors. The mortgage interest rate looks like it has turned a corner. I think it is clearly possible that we'll have 30-year mortgage rates closer to 5% in 2023, which would do wonders for the housing market. This guy is nothing more than a cheerleader for a bull market in housing. Obviously, this did not happen, and I don't think we're going to see 5% mortgages anytime soon. Quantitative easing and quantitative tightening will be one of the bigger unknowns in the years ahead. We're looking at the Federal Reserve's balance sheet, their holdings of mortgage-backed securities. You can see that presently they have $2.2 trillion of mortgages. What's interesting is that they did not have a balance sheet prior to 2008. So we're in a brave new world of economics. This is an economic experiment. And what I find really amazing is the irresponsible juicing of the mortgage market by the Fed from 2020 into 2022, while inflation for housing was running rampant, inflation just jumping through the roof. These geniuses were still stimulating. They were buying mortgages. What is going on? At least they finally stopped and admitted that inflation was real, and they've been reducing systematically and slowly their holdings of mortgage-backed securities. However, they don't just buy mortgage-backed securities, they also buy long-term treasuries. And here again, we see that prior to 2008, they did not have a balance sheet. They didn't have any long-term treasuries. All new stuff. Here's the explosion of long-term treasury purchases in 2020 and into 22, greatly contributing to the inflation that we're all living with and have been living with in recent years. Currently, they have $3.2 trillion of long-term treasuries, and they're trying to wind this down too. We don't know what's going to happen in the future here, but I think this is a big unknown. It can have a huge impact on inflation and the economy. And what we can probably be confident in is that the playbook now is that when we get into a recession, they're going to use quantitative easing to try and stimulate. But all of this is going to be inflationary in the long run, in my opinion. Let's quickly revisit the budget, the deficit, and how it's linked to inflation. For 2024, the government expects to bring in $4.8 trillion, mostly from taxes, and they expect to spend $6.8 trillion for a total deficit of almost $2 trillion. Let's look at individual income taxes. Now recall that I said that there are basically 4 ways that the government can deleverage, that they can balance the budget and right the ship. They can raise taxes, they can cut spending, they can confiscate wealth, or they can inflate their way out of the problem. So I want to hone in on taxes and show you why raising taxes is not an option. When you're running a $2 trillion deficit, if you wanted to make a meaningful difference, you would basically need to double taxes on individuals. So what if you take $1 trillion or $2 trillion more from individuals or corporations? I don't care which. If you take that much money out of a $29 trillion economy, you're going to have the economy in a nosedive situation right away. It's going to be immediate. So they can't raise taxes enough to deal with this problem. And conversely, they can't cut spending enough. When you're stimulating, when you're spending $6.8 trillion, if they took this down to $4.8 trillion, that would be $2 trillion out of a $29 trillion economy. It would be a train wreck immediately. So that's not going to happen. And this is the reason why I say inflation is the only option to deal with the deficits as we go forward. Many investors are nothing more than trend extrapolators, basing their decisions on whatever has worked in recent years, whatever's been hot, and expecting that trend to continue going forward. So I want to draw your attention to the macro trend until recently of the last 4 decades. For 4 decades, interest rates went down, and that resulted in great returns for leveraged assets like real estate, high yield debt, private equity, and other asset classes. But this trend is now broken. And who's to say that we're not going to see an environment over the next 2 decades similar to the 60s and 70s, where interest rates went up and up and up for several decades? You have to be prepared for potential scenarios outside the norm or outside definitely what has happened in recent years. I don't believe that the future is going to be anything like the 90s and the early 2000s. For all the reasons that I just went over, I would anticipate it's much more likely that rates will stay at least where they are and possibly go higher. So let's sum it all up. The growing debt, ongoing deficits, and ongoing balance sheet games by the Fed in the form of QT and QE are all likely to produce more inflation in the years ahead. And that inflation will keep interest rates, for long-term interest rates, at least where they are now, and possibly move them higher in the years ahead. I hope this video was helpful. I hope it gets you thinking about your investments and overall improve your family's financial plan.